Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder at Delphi Digital, which is an independent research boutique providing institutional-grade analysis on the digital asset market. A quick housekeeping item, this podcast is strictly informational, educational, and is not investment advice or solicitation to buy or sell any tokens or securities or to make any financial decisions. For full disclosure, see the bottom of the show notes. Also, our listeners can visit delphidigital.io and use coupon code CHAINREACTION in all caps with no space as a special offer to access our research. This offer ends soon. With that out of the way, today I'm thrilled to have on Scott Army, the founder and CEO of Vision Hill Group. While institutions are starting to warm up to crypto today, Scott began work on his crypto fund of funds years ago, and his first successful strategy launched 6 months ago. Since then, Scott has grown Vision Hill into a full-service crypto company, focused on adding new strategies, providing research, and advisory services as well. Scott has unparalleled insight into the crypto fund scene since Vision Hill is conducting extensive research into these managers, and the data they are compiling is massive. Scott's also one of the first people who helped me on my crypto journey. We went back and forth a lot, so it's great to come full circle and have a friend discuss his journey. I also want to give a shout out to Dan Zoller, a partner and friend of Vision Hill, who's not only helping drive the company forward, but also shares some incredible research on the space. We had to do this podcast over the phone, so the quality isn't immaculate, but it's well worth it. I appreciate Scott carving out the time for it. With that, let's hop into the podcast. Hey everyone, welcome back to the podcast. Today I'm thrilled to have on Scott Army, the founder and CEO of Vision Hill Group. Scott, how's it going?
Good, Tom. Thanks for having me.
Of course, it's a pleasure to have you on. So Scott, give us your intro and I guess just begin by describing what you're building at Vision Hill.
Sure. Again, thanks for having me. Excited to be here. I think it's probably proper to set the table by, saying that we believe investing is changing, and we know that technology is constantly evolving. So we believe asset management in this new digital world will require a trusted and experienced leader that's offering institutional caliber products and services to a evolving, sophisticated investor base. And, at Vision Hill, we're building the digital asset management firm of the future to serve those evolving needs of the investor and client base.
I guess, can you explain what you mean by investing is changing? Like, how would you compare this to traditional markets or traditional investing versus what you're building?
Sure. First, I think blockchains and token incentive structures have really created a new model for capital formation and a new way of organizing and coordinating human behavior. So investing into this new space requires one to be more active than passive, and in some cases requires actual work to actively participate to provision services in these networks. The second way is really that investing is more collaborative than competitive because these are networks and not markets. And since by nature they should really be more distributed, more collaborative, and thinking about how you bring together different counterparties and different individuals to bootstrap the early days of a network.
That makes a lot of sense. Yeah, we recently did a post on Gen Mining, and it definitely is right up that alley. So, I just want to go back a little bit on yourself. I mean, you spent a lot of time at JP Morgan before starting Vision Hill. And for those who aren't aware of your and I relationship, you were one of the first people that helped me out when I was getting started on my crypto journey. So I appreciate that. But can you explain more about your background at JP Morgan, maybe, how you fell down the rabbit hole or what you saw there when you were coming into the crypto scene?
Sure. There's a long version and a short version of this story, so I'll try to err towards the latter. But I spent 11 years at JP Morgan trading high yield credit. So that was corporate bonds and credit derivatives. And I would say that this market, to me, feels very much like the early days of the credit derivatives market. It was a new product. It was something that, an institutional client base, even though they were trading high yield corporate bonds and investing in high yield corporate bonds, they still really didn't fully understand, credit derivatives. And what was required at that point in time was a lot of education. I remember we had what was called a CDS primer from JP Morgan, and we passed that thing out to anyone that would take one because it was really important in just explaining the dynamics of the market, how you could use this as an investment product and what it really was. And so I started JP Morgan in 2005. I was there 11 years, 2005 to 2016. So I saw sort of the pre-crisis boom, the LBO mania that was happening. And, at that time there were talks of $100 billion LBOs and things like that. And then you started to see some cracks in the market in 2007, which led to the global financial crisis. That was obviously a very, very instrumental part of my career in seeing the importance of risk management and seeing the importance of counterparty risk and other things like that. So, my background largely is in risk and portfolio management, is in investing. And so I bring that lens to this new asset class. In many ways, it also trades similarly. I mean, the corporate bond market is an over-the-counter market. Largely, in crypto, a lot of the block trades and institutional trades are taking place in a similar fashion. Even though there's a lot of exchanges out there, OTC does dominate the larger flow trades. So, seeing these big price movements, seeing the way flows happen and fund flows can dominate the market, again, is very, very similar to my background in credit. What dropped me down the rabbit hole was really in 2014 while I was still at JP Morgan. I went to see a talk by Barry Silbert at the Core Club here in New York City. And at the time he was selling sort of second market to NASDAQ, which became NASDAQ Private Market, and starting the early bones of Digital Currency Group, which is obviously a massive player in our space now. And at the time, I couldn't get comfortable with custody. So I didn't do anything financially at that time. I like to say on the trade floor that hindsight capital is up a lot of money, and if it's not, you're in significant trouble, right? So I wish I had in 14, but I didn't. What dropped me down again was in 2016, after I left JP Morgan to start a mobile app and web development company. I was very much deeper in the developer community, both New York and San Francisco, and the community was very much a buzz about Ethereum at that point in time. And I think what drew me in was the ability for sort of that finance and tech come together point, and for programmable value and what that could really do to a lot of assets across our space. And so I began investing, I began trading in the market. The same concern, though, was apparent, custody to me. If I was going to move, significant amounts of more capital into the space, I had to be really sure about my counterparty risk and custody and, sort of hot wallet exchange risk, right? And so that took me, broadly navigating this early 2017 landscape, took me out to Coinbase. I did a bit of a couple-day consulting for them, and talk to them about what I thought it would take for institutions kind of to really commit to this space, the importance of a prime brokerage model, of a custody model, of education, as I mentioned. And I got a lot of my questions answered that way. And through those conversations, I was also talking to, former colleagues and anyone really that would listen about what was happening in this space. And that's how organically Vision Hill was born. It was born really as a trusted way to allocate to this new space, as someone who could be a shepherd and guiding light into it, a trusted way to allocate capital, and a bridge really of this finance 1.0 to this evolving finance 2.0 world that was really coming to be.
That's awesome. So, Scott, when you're moving over from a giant like JP Morgan to starting your own firm, what are the differences, from an infrastructure standpoint, from software, from research and resources? How different is the space at an institutional level when trying to conduct business versus, working at JP Morgan? I'm sure there's a big difference, but anything specific you could share would be helpful.
Well, there's just a ton of differences, right, at many different levels. I think, whether it's an asset management business or whether it's a startup, in your more traditional sense, I think you encounter the same issues. You as a team, you have to wear many hats. So, whereas in a large organization, you're used to staying in your lane, so to speak, and being very, very good at one specific task. In a startup setting, and I'm sure you can relate to this, you have to wear many hats. You have to multitask in a very, very efficient way. That's the first thing, right? I think, in many ways, the asset class is in the startup phase as well. So you compound some of those problems because, if I were to start a fund in credit, the infrastructure is largely there. already, right? In this space, it's navigating a whole new service provider and infrastructure space that is evolving. And so you're sort of compounding those startup risks. Now, I think those things you have to look at it like risk return. There's massive opportunity here. This is a early stage developing asset class and market. And so, yes, there's going to be things that are hurdles that you can overcome. But you have to weigh that against the potential return here. And I think that's truly massive. And so you just have to properly focus on day-to-day execution of the things you need to do in order to get to the next step.
That makes a lot of sense. So, let's now leave your background. Let's jump into Vision Hill. I mean, what's your mission statement and how does that define your business? I know you spent a lot of time kind of carving out why having a mission is so important. So I think it would be worth hearing it from you first.
Sure. I wrote a post on this on Medium. So if you want to check that out for sort of a more deeper conversation on it, it's on our Vision Hill blog. But our mission at Vision Hill is to lead investors into the future of digital assets. That future can be, the future in general can be uncertain, unknown, opaque. And so we see ourselves as a leader in that regard, being a guiding light and a leading voice into this, massive opportunity set. We think about being a leading voice from a research perspective. We think about leading process from an investment process standpoint. We've participated on a lot of working groups to think about what defining leading standards in this market are. And in that way, we think about it as purposeful investing, right? So what we're doing is becoming a bridge of capital from largely an LP base into us as a fund. We are then driving that capital either directly into projects or companies in the space, or fund managers that are then driving it into projects and funds in the space that are really building the sort of next iteration of technology for us as a society.
Got it. That makes a lot of sense. That's interesting. So, as a business, how do you serve the needs that are evolving from the investor sense? I feel like the investors back in, say, 2010 in crypto were hobbyists or, people that had their ear to the fire. But here, I feel like we're switching and now we're getting more institutional. There's a lot of capital flowing in. Do you think that the needs of investors are evolving faster than we could service them? Or do you think that, Vision Hill or the market itself is kind of equipped to handle where we're at today?
So I would actually say it's evolving. Demand is evolving slower. I think that the crypto market is not lacking in supply. I think demand is something that we, in some senses, there was the field of dreams model, build it and they will come. I do think that will happen. But I think, what 2018 has taught us is to probably find that demand sooner, find product market fit, both on a token, project, company level sooner than people were doing. We spent a lot of time on the road recently on our first sort of major road show, gathering feedback from investors. And I think you can segment it in a few different ways. So segmenting it generally, I think there's three camps. There's the curious camp, there's the, early mover, super sharp camp, and then there's the interested, figuring out how to allocate camp, right? The first one is, in those type of meetings, you barely make it past the education phase. And you're not even getting to sort of products, investment edge, opportunity set, other things. You're focused much more on the 101, which I think everyone in this space realizes that there's a lot of work to be done together in that. And I think what you guys are doing at Delphi is amazing in that regard as well. That second camp is probably the early mover family office crowd that has gotten sharp on the space, that recognize the opportunity and are doing a lot of things directly. So they don't necessarily need to make allocations to someone like Vision Hill or a direct fund because they have the sophistication in-house. That third camp is really, I think, where most people are trying to service. And I think that's a really big opportunity set that has yet to really fully realize itself. That's the interested trying to figure out how to allocate camp. We looked at the numbers we track sort of AUM, what our TAM is, what our investable TAM is. And, at the end of the second quarter of 2018, we estimated that the total amount of AUM in the space was about $6 billion. And then as of the end of the year, it was down to about $4.5 billion. That's in just crypto native hedge funds, right? So that's our investment landscape. That's not a big number, right? At the end of the day, it's growing and it will grow, but that's not a big number right now compared to other asset classes, right? And so from an institutional investor standpoint, it's trying to figure out, how am I trying to allocate? Am I trying to allocate in a short-term way, medium-term way, long-term way? How do I view this asset class from an investment time horizon standpoint? And then, once I get there, how do I then express that? And can I allocate to a certain fund? Am I too high of a percentage of someone's AUM? Am I able to scale this investment over time? What percentage of my overall portfolio do I want to be exposed to this asset class, and sort of where does that sit? Does that sit in an absolute return bucket? Does it sit in a venture capital bucket? Does it sit in long short, which is sort of an evolving strategy in the space? I think those are the conversations that we've been having, and it's molded sort of our product portfolio from an asset management standpoint as well.
Got it. That makes a lot of sense. So, for somebody looking for a crypto fund of funds, I mean, are there, how many competitors do you have? Are there 10 crypto fund of funds out there? Are there 100? And I guess the other question is, how does Vision Hill differentiate versus competitors there? I know it might be really early for that question, but just interested.
Yeah, I think there's probably 5 to 10, in our opinion, peers. I won't call them necessarily competitors. I'll call them peers because I think we're still very, very early. And I think it's good to have product market fit. If we had no competitors, I'd be worried, because I don't think our products would suit anyone. So yeah, there's probably 5 to 10. I won't mention them by name, but we're very friendly with a lot of them, and we do share notes on diligence, and I think it's important to do that, right? Again, I think we can all benefit from that. How do we differentiate ourselves? I think we come at it from, we are thematic, thesis-driven investors to begin with, right? It's not, let's find a fund manager, put them in a portfolio with a few other fund managers, cross our fingers and hope for the best. It's what are the, overall overarching thematic areas in this asset class that we want to invest in. For us, it's like kind of at a high level, 5 things. It's infrastructure, programmable value, DeFi or decentralized finance, open finance, as some others call it, active network participation, and then sort of the sound money camp, more of the, money use cases. So what we do is we say, okay, if those are the 5 overarching themes, what is our individual investment thesis within each one of those themes, and how do we go express that? And that can be in a direct way, or it can be in, finding the absolute best fund manager that can do this slightly better than we can, and expressing the thesis in that way. So, in thinking about what our products look like, yes, they are multi-manager products, but it's really from a lens of expressing a thesis on our part that we want to express.
Got it. That makes a lot of sense. And I guess on that note, I mean, for those that are in crypto that might not come from a financial background, what's the goal of investing in a fund to fund? Is it to mitigate risk? Is it to get exposure to areas they wouldn't be able to? What's the key selling point for that group?
I think the easiest answer is diversification of opportunity and diversification of risk. When you look at why the fund-to-fund business models made sense, and really when they caught on was like the early 90s. And we've had a handful of advisors who were instrumental in starting fund-to-fund businesses at that time. It was really 3 things. It was access to new opportunities that were evolving. It was having the sophistication of diligence on the team in order to be able to understand what these strategies were, what the market looked like, and how you could make money from those things. And then having a diversified approach, to that investment thesis. And I think it's really tough for certainly individuals to do that, but I think even, family offices, pensions, endowments, foundations, unless you have, a sophisticated in-house team looking at this market every day, I think these are really great ways to allocate to the space because you're achieving those 3 things I just mentioned.
No, I agree. So, I mean, if we're looking forward and there's large family offices or institutions that want to get involved in the space in the future, which I think we both agree that they're coming eventually, when you sit down with them, or, a fund to fund sits down with them, is it an easier conversation to say, hey, I know you want to allocate, say $1 billion. It would be easier to diversify your opportunities and risk by going in a fund of funds, or versus just one crypto fund? Or does the conversation get more complex where there's somebody that would have to, say, look into all of the funds that, you are personally invested in through Vision Hill? I'm just wondering, if it's a more complex or an easier argument from an institutional standpoint.
I think it depends on who the investor really is that you're sitting in front of. You really have to segment that. I would say for the, high net worth, ultra high net worth, even single family offices, there's a natural selection bias. And so you may be comping us to a direct fund, but you don't have a very comprehensive view of the landscape. And so, you may have a fund that you've been introduced to or you have access to, and maybe you don't have access to another particular fund. And so you're coming at it from a different place. I think when I say it's important to segment the investor base, we like to kind of divide it down: the high net worth, ultra high net worth, single and multifamily office on one side, and then endowment, foundation, pension, sovereign wealth fund, institutional allocators, et cetera, on the other side. And again, what we've heard from them is that people want to express, different theses in the asset class on a time horizon basis. And so the way we think about the product portfolio is short, medium, long. And there's been significant demand for, in certain cases, not market risk. And so that's more of a pure alpha play on the short-term side. That's market neutral, quant funds, et cetera. Kind of your middle play down the road is, at this point, a lot of people what they're really asking for is they're investing in the beta of this market, right? I mean, you want the up and to the right exposure of the asset class as it grows. And so when you do that in an active way, you're asking for that beta to be enhanced in some way. Traditionally, that's called alpha. That can either happen in concentrated positions, or it can happen by sort of barbelling your risk between public and private markets, where you can, the private market side should be more akin to venture capital like returns. That's going to enhance your liquid market beta. And then the longer duration stuff is your venture type buckets. And I think when you have a big drawdown in 18, when you draw down 80 to 90% in liquid markets, investors naturally default to what they know. And they say, this might be a longer term investment than I'm used to. I want to approach it more from a blockchain technology standpoint and a venture lens, right? And so they defer more towards the venture products. And I think you've seen that with some of the larger venture funds that have raised money from traditional investors and pensions and things. It's just an easier on-ramp for them. That said, we believe the foundational opportunity here is really like in these new token structures and incentive networks, and that's the new way of organizing human behavior, as I opened our podcast with. And while that may temporarily have fallen out of favor due to the liquid market drawdown, that truly to us is the larger opportunity set here. And I think that, the waves of change will flow and ebb and flow, but I think we'll see that come back, over the next year or so.
That makes sense. That's great. And Scott, one more question on this topic before we move on, but I've seen a lot on Twitter about, hedge funds or crypto funds. And it seems to me like a lot of the crypto funds themselves are all involved in, a lot of the same private deals. Like they're all passing on, 90% of the deals, but they're all kind of bidding up the 10% of deals they like. And then the valuations get crazy. Does that kind of go against the diversification idea of investing in multiple funds? I mean, in my mind, these fund managers still have to make the decision of when they're going to get out or when they're going to invest. So I don't really see an issue there, but interested if that's ever crossed your mind.
Yeah, there's two ways, sort of 2 points that I have on that. One is that that's why you have to think about this on an aggregate risk basis. If you're just selecting managers and putting in a portfolio from a diversification standpoint, you may not actually be achieving diversification at the underlying position level. So it's really important to drill down to that level to, when you're putting together a portfolio, understand how you're getting diversification so that you're not just overlapping on the same 5 deals, right? As far as valuation that you touched on briefly, I think these things are inherently different. Yes, they are raising money akin to venture capital in your seed, Series A, Series B, Series C type rounds. But why I think you're seeing larger valuations is because, these are networks at the end of the day. So they may be raising capital earlier in their life cycle, with a much larger TAM, and then perhaps not raising capital in between before they go testnet to mainnet and actually launch a network publicly. And so, there's not the step function of capital raising necessarily. And some of the projects are starting to think about proper distribution and Gini coefficient and other things, so that you can achieve, proper distribution of incentives, as these networks launch. But I think that's why you're starting to see higher valuations at the earlier stages, because it's not that natural step function you have in venture capital.
Yeah, that makes sense. I see some of the headlines, it just blows my mind, between Hedera and Definity. It's just a lot of people don't know how they get there, but that makes sense. So circling back to Vision Hill, when did Vision Hill exactly go live? And I guess it would make sense to kind of get into your investment thesis from that perspective as well.
Yeah, so we launched our first strategy September 1st of 2018. We did that intentionally because we thought we could get some access to some of the private deal flow over 2018 that otherwise, had we waited, we would not have been able to get access to. That main strategy is what we call enhanced beta. I touched on sort of what that beta thesis is, but we enhanced that beta really in two ways. We managed the liquid part of the portfolio to a beta of higher than 1 in times that you see the market rising or anticipate the market to rise, and below 1 in times where you want to get more defensive, right? We define beta as Bitcoin, it being, as of today, 58%, of the liquid crypto market. That is the beta at this point, right? So you manage that to a higher beta than Bitcoin, and enhance that beta on the liquid side. And then you do it on the private side as well, because as I mentioned, you have venture capital like returns in the private crypto market that can far enhance those liquid market investments. And so that was the primary strategy we launched. From a strategy standpoint, we anticipate launching 2 other things, as I touched on, sort of the shorter term alpha and then the longer term venture opportunities in short order.
That makes sense. Is that due to market demand? Are people in the earlier strategy come to you and say, "Hey, Scott, we'd really like if you rolled out these other products," or are these things you're foreseeing that you think would have significant demand here?
They're absolutely as a result of market demand and market feedback, right? I don't, to use that same Field of Dreams analogy, we're not looking to launch products without market demand. And so, the alpha has been a response to someone coming to us and saying, I want to allocate a fair amount of capital to the space, but, the way I want to do it is not in the beta play. I'd rather seek the alpha and the inefficiencies in this early market. And so is that sort of something that you guys can do for us? And so that's been the impetus for the alpha strategy. The venture opportunities longer duration strategy is again based on demand. It's based on someone saying, I believe this to be a longer term investment. I'd like to, have both equity and token investments, but perhaps not have as much liquid crypto market risk and mark to market on a monthly basis. I'd like that to look a lot more like a traditional venture product. Now, that could be a hedge fund structure. We've seen Andreessen move to an RIA. We've seen others sort of follow suit. The structure is less important. It's more the investment duration response to the market demand.
Got it. And Scott, you're somebody who sits across the table from, more fund managers than probably anybody listening here. I'd love to hear how you evaluate fund managers, and, I would love to hear the quick things that you see, if there are any that, you would just leave the table from, of course, professionally, but just anything that stands out that you think could be an easy tell on a manager that might not be fit, or might be too immature and experienced to handle the market. Definitely interested there.
Sure. We analyze managers based on, quantitative and qualitative factors. We have an advisor, like to say, it takes 3 years to get a 3-year track record, not a day sooner. That is absolutely applicable to this asset class. There are not long track records. Most of the managers that do have longer track records, have largely had Bitcoin funds for periods of time because there really wasn't an asset class to invest in in many ways, until a few years ago. So that said, we do have pretty comprehensive ways of analyzing individual fund performance on our side, not just looking at numbers, but sort of looking at upside and downside volatility, looking at its beta, how it actually trades versus Bitcoin or versus other funds that we may have in the portfolio. And so we do a lot of quantitative analysis with the data we have in-house, which is, at this point, day by day, becoming very, very comprehensive. On the qualitative side, it's, investment due diligence and operational due diligence. These are just kind of standard ways of providing diligence. On the investment side, it's, analyzing team, analyzing the investment strategy and philosophy, what thematic areas of interest or is this particular manager, interested in? Does that align with what we believe to be, areas of opportunity? And then what is their investment process, right? Is that disciplined and repeatable? One way we would walk away from the table is if someone sort of just seems like they are finding an opportunity and not running sort of a repeatable investment process, investment committee, things like that, that make what they're doing repeatable on a month-to-month, year-to-year, and longer basis, right? And then what's their specific edge? What makes them unique? That could be their crypto native expertise. It could be, their software expertise on sort of generalized mining, software provisioning, supply side services. It could be that they have an existing quant background where they've traded quant macro and they're applying that to this new asset class, and they've taken the learnings of the models they've had over multiple asset classes and applied it to the Bitcoin futures or Bitcoin spot market, but what is that specific edge, right? And then from an operational diligence perspective, we see operational risk in the asset class potentially being higher than market risk in some cases. Why we say that is because we're still very early, and a lot of these fund managers are very early in their life cycle. And so things like the obvious custody, security, cash controls are really important. GP viability is one big one we talk a lot about. That's really like, has the fund manager thought about, their operating budget, how they scale their team, and do they have sort of have they capitalized their fund in a proper way in order to be in existence to even effectuate their investment strategy, right? Another one is valuation. Have people thought about a valuation policy? We've seen that become a hot button item as we've gone through the 2018 audit cycle here. A lot of the top auditors in the space are moving people towards best practices and valuation. Those are all things we would care about on the operational diligence side, and it's really comprehensively, coming together that quant, IDD plus ODD when we look at a manager.
Got it. So this is way more, I think a lot of people in the space think that allocations are quick and you sit down, have a conversation and send a check. But what you're saying is that it's an extremely extensive process and there's numerous check boxes that, have sub bullets that are, pretty intense from an examination standpoint.
It is. I mean, we generally say that it probably takes at least 6 to 8 weeks beginning to end for us to run a process. And that's if we've probably known the manager or tracked them for quite some time beforehand. We like to track performance of a manager, investor letters, updates, to make sure that sort of the book is trading the way that they sold it, right, out of the gate. So are the numbers consistent? Is it performing consistently with what we think they are, right? That's really important. And so we'll track managers for quite some time. And honestly, that can be a frustrating process because I think everyone's looking to get to check much quicker, and certainly that's for our side as well, as far as our LPs. But you have to understand that I think there's the patient approach here to forming long-term partnerships with people you're allocating to is really important because you want to be able to scale up and grow together in that allocation. And if you don't truly understand who you're partnering with, it's probably not good from the get-go.
Yeah, of course. I mean, what's the review process like on, say, weekly, monthly, or quarterly basis? I mean, after you do all this diligence on managers and see everything they're involved in top to bottom, how often is this updated or, do your LPs care, or is this more for yourself, I guess, at that point?
Absolutely are. We're big on transparency. And so, we like to provide our investors, pretty granular transparency into not only our aggregate risk portfolio, but also, everything we're hearing from individual managers. We're in touch quite frequently at a minimum, like on a monthly basis, obviously for performance and other updates. We do full quarterly portfolio reviews with everyone. And so that we can run a quarterly portfolio review for us internally, and then in turn, turn that around for our investors. This isn't a run a 2-month or 2.5-month front end diligence process and then go away and hope things work out. There is that's the whole part about active management here.
Yeah, Scott, I misspoke. I meant to say, the granularity that you provide from the funds to your LPs yourself, is that something that differentiates Vision Hill, or is that something that you think LPs in the space come to expect, I guess?
Well, we try to be a leader in that regard, in transparency. I think that we try to do things where the market is going, not what the market necessarily is satisfactory with currently. And so that's the way we approach every communication with our investors. I can't really go into super granular detail on what we provide. Happy to do that offline to anyone who's interested, but very, very, very transparent, with communication, performance, et cetera.
That's awesome. We need more of that in this space. Leading into that, you guys are one of the first to introduce the active benchmark in crypto. Would love to hear more about that, why it's important, and I guess how it's changed since you've introduced it.
Yeah, that's something we're very, very excited about. So we started that in Q2 2018. We needed to get to a point of statistical significance on data points in order to launch that. Otherwise, we would have done it earlier. And so we launched that with plus 30 data points in Q2. As we'll probably release Q1, perhaps by May 15th. There's a slight delay on the quarterly updates there, since it takes, your fund administrators approximately 30 to 45 days in order to aggregate NAVs. And so that compilation of performance from managers takes a bit. That evolution really started because when we sit down with managers and we ask them, what is your benchmark? What are you benchmarking to? There hasn't been a great answer. The natural one would be Bitcoin and perhaps some of the other passive indices out there, like a Bitwise or a Galaxy index. But there's no great active management benchmark. And so we kind of put our stake in the ground in Q2, and that's evolving into what's becoming a Vision Hill active crypto index. We're in discussions with a few people that I can't mention in order for that to actually become a full index, uninvestable index to start, but perhaps investable down the road. And really that serves kind of two purposes. It serves a purpose for fund managers to be able to comp themselves to an overall active index. And then we actually drill down into 5 separate strategy classifications as well. So fundamental, opportunistic, quantitative, smart beta, and venture. You can read about more of those on our Vision Hill blog, on any of the benchmarking work we put out. So I won't do that here. But it's important to be able to let fund managers comp themselves on an apples to apples basis among peer strategies, right? So for example, you wouldn't comp a quant strategy to a long only strategy. It really wouldn't make any sense. And so, the Vision Hill active quant index would be what most quant funds would want to be comping to, because it's a much better relative peer benchmark on active management.
No, the ability to compare apples to apples is huge. And that transparency and product, if you roll it out, is going to be huge for helping investors understand the space, I think, from what they're used to, especially coming from Wall Street or financial backgrounds. I guess taking that a step forward, what difficulties have you encountered, do you think, for Vision Hill Group overall? I'm sure that there's numerous things you face when you're building out Vision Hill, but I guess I'm more interested in, what difficulties you faced from answering questions for investors, or maybe in building the infrastructure itself for Vision Hill, or maybe just understanding what products, the market might need here.
I think there's a lot of things, right? I think you touched on a few of them. I'd say the infrastructure maturation has been one of the difficulties in the space. I just touched on it, but even on the fund administrator side, I think there's a lot of people are doing great work here. I think it's because it's a new asset class and there's new ways of sort of valuing these assets and thinking about posted collateral perhaps for short positions or positions in custody and how you have transparency, via read-only access as a fund administrator, in order to prove validity of assets. I think those things are all things that we've been encouraged through 2018 to see progress on. That said, it's provided difficulties just simply in something as simple as providing a NAV, right, to investors. Those things have been delayed from the fund administrator side or in aggregating those things. And, we want to move towards, again, traditional market best practices, where you can put out a NAV T plus 5 to 10, and investors come to expect that. We're working towards that. I think in the infrastructure across the asset class, not just on the fund management landscape, but, you look at that as far as exchanges and regulatory exchanges and custody itself for assets. Like infrastructure is getting there, but that's been one of the major difficulties that we've encountered.
That makes sense. And Scott, I think, me and you went back and forth in the summer a bit, brainstorming custody, and I had a couple of questions for you. It's one of the first reports we wrote. What do you think investors are waiting for? I mean, there's custody obviously comes to the forefront. There's obviously a lot of startups that can handle custody, but huge investors want to deal with Bank of America and Fidelity. They don't want to deal with Zappo and Coinbase and Gemini. Do you think that custody is the number one holdback for investors, or do you think it's education, or what is it in your mind here?
I think education is more important than custody. I think the existing custody solutions we have in the market are I think, more than satisfactory for where we are in the market. I think one of the big things from a fund management standpoint was, you needed a qualified custodian in the market. We now have some qualified custodians in the market. Whether you are satisfied with the brand name of those qualified custodians is an independent thing that someone can evaluate on their own. But I believe, we have those solutions currently and they're only going to get better. I would say the bigger hurdle is proper education, understanding of the opportunity here, understanding the technology, understanding the, broader, paradigm shift that is happening here in this asset class.
So Scott, I think a big question in the space is a lot of people approach the space as, just wanting to invest in Bitcoin. And I think it's a hard conversation, or it might be a hard conversation to convince people to diversify away from, the largest crypto asset we have and the strongest one. How do you approach conversations, and convince people to diversify their opportunities and their risk into funds, specifically your fund to fund? Or is that kind of not your place, as they've already decided that they want to diversify their opportunities and their risk, and that's why they come to Vision Hill?
I think for us, we try to think about it as, serving the needs of, an investor base from a very comprehensive standpoint. And so it's really asking them what they're looking for, how they want to allocate, and how we can serve that. Perhaps we are able to do that with our private fund strategies, and perhaps not. And if it's not, then, how can we provide data, provide research, perhaps provide advisory services to them to think about a bespoke portfolio or assisting in diligence. It's really responding to the investor need more than bringing what we currently have to the table. I think to your point about, sort of Bitcoin versus a multi-coin universe, I think that we absolutely believe, and I absolutely believe in a multi-blockchain, multi-token world. I think it would be a bit narrow to think that this technology would only be used in the single asset way. That's the bet we have made and are making actively every single day at Vision Hill, is that this is a much larger paradigm shift and a much larger asset class than it is today. And we're very, very excited about its continued growth.
I love that. And Scott, last question for you. When you sit down with family offices or investors or institutions that want to invest, how much of the tech do they actually care about? Are they more interested in, say the macro argument about Bitcoin, or were they really interested in, Lightning, Ethereum with Serenity, Cosmos and Polkadot competing on interoperability? Always interested to hear that.
I don't think there's a tremendous amount of people that are in the latter camp, as you just mentioned, yet. And if they are, they're probably employing direct or allocating capital directly, right? Because if they are at that level of sophistication, they probably fancy themselves as with the ability to allocate their own capital, right? So most of the conversations are not in that regard. It's much, much earlier stage. And it's understanding the technology in the sense of like, what is the technology to begin with? Like, how is it applied to markets? And I think you have to use a lot of, familiar analogies for people to truly understand like how these things are applied, perhaps the history or going forward, right?
That makes sense. So Scott, where could people follow you on Twitter or your website, or do you prefer LinkedIn? Where can people learn more about you?
Yeah, so Twitter and Medium is just @ScottArmy_. You can also follow @VisionHill_. Twitter, Medium, LinkedIn, any of those work. And we'll be rolling out, a more comprehensive website probably within a month with a lot of the stuff that I talked about and a lot of the data that we have internally.
That's awesome. And for everyone listening, Scott's going to be linked in the show notes along with Vision Hill. But Scott, it's been an absolute pleasure having you on. Thanks for your time.
Thanks a lot, Tom.
Hey, everyone. Thanks for listening to the podcast. Please rate and review it to help other people find it. And visit delphidigital.io and use coupon code ChainReaction in all caps with no space to get an exclusive offer on accessing our research for our listeners.